Most investors think the hardest part of investing is making money. It usually isn't. The hardest part generally comes after you've made big gains. Strong markets, good decisions, that's what can create those gains in the markets. But that growth creates one problem that usually doesn't get discussed. Do you want to pay taxes, or do you want to keep making more money? At first glance, that's an obvious question. Nobody wants to pay more taxes. But it's not as straightforward as that as you look at the long-term time horizon. When markets are strong and portfolios grow, left unchecked, some positions can create massive unrealized capital gains. Now, those unrealized gains are a good thing. It means things went up, you did well, but can also create problems down the road. Now, selling those positions, that triggers tax. And it's obviously easier just to hold that. And you might have the sense that it went up, it's going to continue to go up. Why would I get rid of it? But as that position grows, it can potentially create big risk in your portfolio. Now, this is a tax decision. We're not talking about market timing. If you leave that position unchecked though, that risk could hurt you and your retirement. We call this situation that silent drift. When you started, you had a well-diversified portfolio. Different geographies, different sectors, different asset classes. But as markets do what markets do, some things did incredibly well, some things lagged. And that might leave you with massive gains in those big positions that are now dominating your overall portfolio. Now, all of a sudden, your financial plan and your retirement are tied to just a couple positions. The situation didn't happen because of choice. It happened because of a good outcome that was unchecked for years. Now, of course, there's very real reasons why these positions are left where they are. It might be a market decision. You think that stock continues to go up. And of course, the tax decision of having to pay the tax now, reducing your investments, and trying to make up for that growth in the future. Now, I'm not saying holding that position doesn't make sense. I'm just saying the risk of having one position overshadow everything else is a risk you may not be willing to take. Again, the issue isn't holding that position. The issue is why are you holding that position? So there's a case for trimming that position. It doesn't have to be all or nothing. If you really like that position, but it's simply gotten too large, then you could look at trimming that position. It's not a market timing decision, it's a risk prevention. We all know that future returns are uncertain. Now, by trimming, you are going to trigger some of that capital gain, but it allows you to time that so that you don't have to take the entire capital gain all at once. And remember that deferring tax is not the same as not paying tax at all. Now, the decisions around diversifying your portfolio or keeping these large positions is often a behavioral finance question. Now, loss aversion comes into play because paying tax makes it feel like you losing a part of that position, even though the only reason you're paying tax is because you had a big gain. Anchoring can come into play where that position may have been slightly higher than it is today, and you want to make sure it gets back to that high before you sell. And of course, something like regret avoidance, where you don't want to sell that position. It's done so well for you. You don't want to sell it now and then watch it move up even further when that large percentage of your portfolio was in it. How much more could you have had if you had just kept the entire thing? So with all of this, sometimes inaction feels safe. But if you take a step back, you realize that the lack of diversification in your portfolio can really end up costing you. Most people think that the decision is either sell it all or hold it forever. But that's rarely the best choice and often not the action we take. The question isn't, should I sell it or hold it? The question should be, how can I manage the risk while keeping what's working for me? That's where we use structured, intentional trimming of positions that get oversized. It's not market timing, it's portfolio engineering. A simple way to think about this uses 4 steps. Step 1, maintain the core. Long-term, high conviction, well-diversified positions deserve a spot in your portfolio. Step 2, trim the excess. If a position gets overweight because it's gone up too much, then just trim that extra percentage and roll it back into your well-diversified portfolio. Step 3 is reinvesting intentionally. You've created a well-diversified portfolio, so if pieces of that portfolio have outperformed, you trim some of that excess, it makes sense to redistribute those funds into some of those positions that have lagged in the short term. Adding to those positions will keep your risk level the way it was designed to be in your portfolio. Fourth, and something we do regularly with all of our portfolios, is systematize the process. If you're constantly rebalancing your portfolios to the weights that they should be based on your diversification and your risk level, then it removes that emotional bias towards holding something that's growing and creating those oversized positions that add way too much risk to your portfolio. The goal in managing your portfolio isn't perfection, it's discipline. So you're thinking about the question of whether you should sell your large position or hold it, whether you should pay that tax or continue making money. Here's what you really need to consider. Are these decisions created based on your risk level or your emotions? Paying taxes along the way isn't a failure of your plan. It's actually proof that your plan is working. Your portfolio shouldn't be structured based on where you were. Your portfolio should be helping you towards where you want to be. When you look at your portfolio now, is it structured based on your goals and where you're headed? To me, that's a conversation worth having.